Hey, what's up, everyone? Welcome back to my world of stocks. So, as many of you know, Bridgewater Associates continues to be one of the largest investment firms in the entire world with over $170 billion of assets under management. And it was, of course, founded by one of the most famous investors of all time in Ray Dalio, which, after retiring from the CEO position, Ray continues to serve as the company's senior investor. He's a member of the board, and he even oversees and mentors their entire investment committee, which he's even said that he plans to continue doing for the rest of his life. So, in other words, the majority of Bridgewater's biggest investments are likely still going directly through Ray Dalio. And not just that, but with the monumental rise of artificial intelligence, well, Ray has also been making gigantic bets on several AI companies, which in today's video, we're not only going to run through 5 of their biggest AI stock purchases from their most recent SEC filings, but I'm also going to rank them from best to worst too, based on my own personal opinion of each one. So it's going to be a ton of fun. Can't wait to share these with you. It's actually 5 very interesting AI pickups here that you probably wouldn't have even been able to guess yourself. So I can't wait to share these with you. Make sure you smash that like button, subscribe to the channel if you haven't already. Those 2 things really help keep my channel alive, and it means a lot to me. So thank you for that support. But let's go ahead and jump straight into this list. Now, we'll be sorting these from smallest to largest purchase in the quarter. And coming in at the first pickup here, the smallest of the bunch, we actually have a stock that I've always wanted to own myself in Adobe, ticker symbol ADBE, which they added another $144 million of in the quarter and nearly a 150% increase. And look, there's many reasons to love a stock like Adobe, especially for how sticky their creative cloud subscription service has become, consisting of industry standard products for creators like Photoshop, Illustrator, Premiere, and more, which ensures tons of recurring revenue for them, as pretty much anyone in the field will absolutely require these platforms for everything they do, giving Adobe #1 market share in areas of design, editing, rendering, application development, and more. And that's also led to just as strong as financials as you would expect, with both sales and profits breaking new record highs every year. But for me personally, one of the biggest reasons why I want to own the stock myself is because I use most of the products too as a YouTube creator, which, if there's one thing that I've always preached to you guys, it's to invest in companies that you yourself use, or that you're very familiar with, because it'll make it that much easier to keep track of not only their business, but also just their various products, their upcoming launches, and even their competitors and the overall market that they operate in. Now, the only reason why I've never bought the stock myself, though, was because the stock had almost always traded for a premium and was consistently rising higher every year, to the point where I kind of just felt like I might have missed the boat on this one, especially during the pandemic, where it soared to a high of nearly $700 a share. However, coming off the pandemic, where demand from people staying home started to fall, the stock price also took a tumble, having lost about 40% of its value from the top, and it's leaving the valuation now even cheaper than the sector on most metrics. Now, to be honest though, I've been busy this year buying up many other different stocks, to the point where I kind of just forgot about Adobe. But this video actually made for a great reminder to me that I do need to consider actually jumping in here soon, even if it's just to kind of dip my toes in a little with this one, because I do really like them overall. I think it's a business that is very strong. They're not likely to ever go away. And if anything, I think the addition of artificial intelligence now being integrated into every platform that they offer will only make the entire ecosystem even more attractive to developers and creators, and it'll just make the entire ecosystem even more sticky long term than it already is. So at this current price, I think it's definitely worth considering, and I'm going to rank it pretty high here at #2 until we see what else is on this list. I'm heavily thinking about buying the stock myself here soon. All right, speaking of other stocks still on the list, up next, we actually have a cybersecurity specialist, which is clearly going to be one of the most important areas of AI long term, especially to protect all of that data and infrastructure related to AI. And that stock was in Palo Alto Networks, ticker symbol PANW, which they first picked up the position just the quarter prior, but have now increased it by a whopping 27,000% this latest one. And I will say, I actually like this one a lot too. In fact, it's another stock that I've thought about in the past of owning myself, mostly because of their market leadership, controlling more than a quarter of it, according to Omdia Research. But it's not just size and leadership that Palo carries, it's also amazing momentum for that size, which is highlighted in Canali's Global Cybersecurity Leadership Matrix, where Palo dominates both categories. The reason for that is largely due to their investments in AI and machine learning that are now automating the really entire process of detecting online threats much faster and more efficiently than a human counterpart ever could, while also fueling their unique multi-platform strategy consisting of Prisma, Cortex, Strata, Unit, and more that together just provide customers with a unified AI-driven cybersecurity ecosystem that simplifies all the operations and enhances protection across all environments. It essentially gives customers more choice and solutions for whatever their specific business or platform needs and at their specific budgets. And that has really just been a unique approach for them that has really differentiated them, and it's just led to a lot of financial success for the company too, with both sales and profits soaring in recent years, even going from negative net income in prior years to positive in the last two. And that's something that a lot of cybersecurity stocks kind of struggle with, but Palo has been doing a great job more recently, with both sales and EPS rising by double digits last year too. Again, overall, I would absolutely love to own a stock like this, especially a leader in cybersecurity that I have no doubt will only grow larger over time, and more important, with almost every analyst out there projecting it to be worth trillions of dollars long term, especially with the rise of AI. However, there's only one specific reason why I've never gotten around to picking this one up myself, and that's because of the rich valuation, where the stock consistently hovers near an all-time high, while their PE ratios also trade for literally hundreds of percents more than the rest of the sector. So even though I love the company, business-wise, I'm just not ready to buy the stock itself, at least not at the moment. But yeah, because of that, I'm going to rank them lower than Adobe. I'll put them at number 3. Coming up next, though, we actually have a new stock that I've never covered before on the channel. Very interesting pickup here, and that was in Service Now, ticker symbol NOW or Now, which they added another $166 million of in the quarter, and that was an increase of more than 300%. Now, if you've never heard of this company, ServiceNow offers a cloud-based platform that helps really other large companies organize much of their business and their work patterns into better structured digital workflows that improves overall efficiencies. For example, they make it easier to delegate tasks, support hybrid and remote workers, execute decisions faster, and even trim expenses. And more recently, their new AI integrations have boosted each of these services even further with all kinds of new automation tools and apps, and even chatbots to enhance the platform. The result being similar to what I've described to you guys in the past with other companies that specialize in using AI to improve efficiencies, like Palantir, for example, who see really rising demand regardless of what the macroeconomy is doing. Because if the economy is strong, companies will have larger budgets to hire companies like Palantir or ServiceNow to help them grow and become stronger. But even when times are rough, like has been the case more recently with inflation and interest rates and even tariffs, well, there too, these companies will still hire ServiceNow in order to run leaner and more efficiently while cutting costs. Case in point, over the past 2 years, Now's number of customers spending over $5 million per year has actually grown from around 300 to more than 500 last quarter, while subscription revenues have also continued to soar by more than 20% each quarter. And that's huge because these subscription revenues also carry giant margins of more than 80%, while those same customers not only renew their contracts every year at close to 100% rates, but they even increase their spending by large amounts too. In other words, Now's products and services are so effective that customers keep coming back for more, resulting in a very sticky business long term. So although net income is relatively low at the moment compared to sales, this could change dramatically in the future when the company starts focusing more on running leaner and increasing profits as opposed to a bigger focus on growth. Unfortunately for me, though, and anyone else that is not already in the stock, the price currently sits near a record high, with even the most forgiving valuation metrics like a 5-year forward looking PEG ratio still sitting about 25% more expensive than the sector, while current PEs trade even higher at hundreds of percents more too. In other words, this is a very strong growth stock, but it also trades like a premium growth stock. So although there's many pros within the business, the cons tied to the valuation are a bit much to convince me to buy the stock at this moment. And I also just have a little more faith and confidence in the need for cybersecurity long term. Just feel like there might be a little more growth there. We'll see. Could be wrong about that. But either way, it was kind of a toss up between this one and Palo Alto. I'm giving Palo Alto the slight edge just because I like cybersecurity a little bit more as a market. But that is going to leave us now, though, guys, with the final two stocks of the list. And these were the two largest purchases. And coming in at number 4, well, it's actually a stock that I own myself in the company known as the Chinese version of Google, and that is, of course, Baidu, ticker symbol BIDU, which they increased their position on by nearly 1,000% during the quarter. And the interesting thing about this one, guys, is that if this was really any other time or situation globally, if Baidu was anything other than a Chinese company, this would probably be one of the absolute best stocks in the world to be buying right now, as this is a company with, like Google, the most search market share in Asia. They're one of the biggest in digital advertising. They launched the first robo-taxi service in China, and they're even number 1 in cloud AI, which, speaking of AI, they're also arguably the biggest play on it in all of China, with not only their own AI chips, large language models, all the data to fuel it that you'll probably ever need, all the power and infrastructure in cloud to facilitate it, and they even have the most AI patents of really any other company in the entire world too. And yet you could get all of this entire AI amazing package for a stock price that has now lost over 75% of its value from the top, leaving their PE ratio around 50% lower than both their own 5-year average and the sector median, which is an incredible value for a company like this that is so dominant and that is still breaking record highs on both the top and bottom line. However, again, this is a Chinese company with a VIE structure, meaning you don't actually own the underlying company when you buy the stock, but rather you just have a contract with really an offshore shell company. So if China were to ever crack down on or revoke a VIE, well, outside investors like myself could potentially see all of our rights just kind of vanish overnight, leaving us with shares that really become worthless. Personally, I don't think that that's likely to ever happen because of how large and kind of interconnected globally this company is and how important it is for China. But it is still a possibility nonetheless, on top of which all of the tension and the trade war stuff going on with the US and China only adds to these concerns, especially if the Chinese economy tanks even more than it already has, causing digital ad rates to plummet even further, and thus hurting a company like Baidu by quite a lot. Still, it is technically the only stock on the list that I actually own myself. So almost by default, I'm going to have to rank them at number 1, even though they're probably a bit riskier than the others that we've talked about. And I only limit my shares to around 3% of my overall portfolio because of that risk. Coming in at purchase number 5, though, the largest of all, we actually have another Chinese stock. This time, though, it's in the e-commerce and cloud computing giant Alibaba, ticker symbol BABA, which they added another $587 million of at an increase of more than 2,000% last quarter. But yeah, I mostly like this one too, as just like Baidu is, sort of Google of China, Alibaba acts as like an Amazon clone, which, by the way, most people don't even know this, but Alibaba technically has even more e-commerce market share than Amazon by gross merchandise volume, while still being the largest cloud provider in Asia and third largest in the entire world too. Or not, I shouldn't say third. I think they're fourth, right after Google. Anyway, This obviously gives them a ton of exposure to AI, but more recently, they've pushed even further into these new technologies. For example, they've been investing in new AI startups like Zipu AI, Moonshot AI, and Minimax, all of which offer software services tied to large language models, chatbots, text, speech, image, and video generation, and other AI platforms too. Alibaba themselves also announced this year that they'll be increasing their AI spending to more than $52 billion over the next 3 years, which is more than they've spent over the previous decade. And part of that is also tied to the launch of their new LLM, large language model, called Qwen, which they claim has even outperformed rivals like DeepSeek and ChatGPT on certain benchmarks related to reasoning and multimodal AI. Now, all of these new growth initiatives, though, have actually helped the stock recover a bit this year, climbing by over 40% year to date. However, from the top, Alibaba is still down huge at over a 60% decline, leaving behind a dirt cheap valuation with a PEG ratio of not only less than 1, but also a whopping 55% lower than the sector median, which is extremely attractive for a company as strong as this, that last year did over $32 billion in sales on 7% growth, with adjusted EBITDA soaring by 36%, their cash rising to over $50 billion, and with their e-commerce businesses growing by double digits too, while cloud grew by 18% and AI revenues by triple digits for the 7th quarter in a row. Literally the only reason why anyone could argue against owning such a strong stock like this, company like this, is simply because it is a Chinese one with a VIE structure like Baidu, which I can understand is a big risk given all the tensions with the US. But if it wasn't for that, this would probably be my absolute favorite stock in the entire market right now. So I can see why Ray is choosing to buy more shares here, and I'm still going to rank it number one on this list here, just because of how strong they are, aside from the high risk of being Chinese. But yeah, there you have it, guys. This is my ranking. I think it's a very good list here of AI pickups by Ray this past quarter. I mostly agree with all of them, and I wouldn't mind owning really every single one of these myself too. At the current prices, though, I do think Alibaba, Baidu, and Adobe are probably the best options among them. And like I said, I actually plan on buying Adobe myself soon too. So hopefully I'll be able to make that happen here. But what do you guys think? Do you own any of these stocks, and do you agree with my rankings? I'd love to hear your take on it. Would you make any changes to it? And yeah, let me know what you think down below in the comment section. But thanks again for stopping by, my friends. I hope you enjoyed the video. It was a lot of fun hanging out with you, and we'll do this again very soon. I'll catch you in the next video. All right, take care, everybody. Hope you're all doing well. Bye-bye.